Today, we're pulling back the curtain on a slice of the travel world that, well, it gets a lot of attention both from bargain hunters and serious investors. We're talking about ultra-low-cost carriers.
That's right.
And specifically, we're doing a real deep dive today into Frontier Group Holdings, Inc. You'll see it trading as ULCC.
Mm-hmm.
We all know how tempting those super cheap flights can look, right? But what's actually going on behind those rock-bottom fares? That's what we want to unpack.
Exactly. This isn't just, about the planes or the ticket prices. It's really about digging into the financial mechanics, the nuts and bolts of a company that basically lives and breathes this ultra-low-cost idea. And to do that, we've pulled together a pretty hefty pile of recent data for you.
Yeah, we have.
Everything from detailed financial metrics, ratios, insider trading reports, what analysts are thinking, and, news headlines going back from late 2024 right up into the middle of 2025.
Mm-hmm.
Our goal here is simple. Pull out the really important stuff, help you understand Frontier's complex financial picture without getting lost in, tons of jargon.
Right.
We'll look at the numbers, who owns the stock, what moves they're making, and just the general feeling around ULCC in the market.
And it really is a story with broad appeal, isn't it? It's this mix of, potential investment angles, how it affects us as consumers, and frankly, just the sheer challenge of running an airline like this. So whether you're thinking about investing or you're just a curious traveler wondering where the airline industry is headed, or maybe you just find it fascinating how big companies handle, really turbulent markets. Frontier is a genuinely compelling case study, a real high-stakes game. So get ready for maybe some surprising details and hopefully a few aha moments. Let's really get into it.
Okay, sounds good. So let's start with the basics. Frontier's core identity. They are, and they say this very clearly, an ultra-low-cost carrier. And their whole philosophy is summed up in that phrase, low fares done right.
Right, done right.
And it's not just a catchy slogan, it's really the foundation of their entire operational strategy.
Yeah.
Every single choice they make, which planes they buy, how they handle bags, staffing it all, seems to funnel back to this one core idea: push costs down to offer those super low headline fares.
And you absolutely see that reflected in how they run things, especially their fleet. They operate 120 Airbus single-aisle planes, and it's a very specific mix. 13 of the A320ceos, that's the older engine option.
Oh, right, the current engine option.
Exactly. The 82 of the A320neos, the new engine option, much more fuel efficient.
Big focus there.
Yeah. Plus 21 A321ceos and 4 of the newer A321heos. So you can see they're definitely bringing in those newer, more efficient models. But it's not just the planes themselves, is it? It's how they pack the seats in, the weight-saving tricks they use, like lighter seats, even how they process baggage. It's all designed meticulously around this goal they state, being the most fuel-efficient U.S. airline.
It really is. That focus on efficiency is absolutely key to their whole cost-saving approach.
Absolutely crucial.
Yeah, it's a very deliberate decision to minimize fuel burn. Anyone in the airline business knows fuel is one of the biggest operating costs, if not the biggest.
Oh, for sure.
So by picking these specific planes and just relentlessly optimizing everything they can for weight and fuel usage, the idea is they can pass those savings on as those low fares. Now, in terms of how they make money, the company is run as a single unit, just providing air travel.
Simple enough.
Yeah. And it's important to remember, most of their money comes from domestic U.S. flights. They do fly internationally, but it's a smaller piece of the pie.
Okay. And they haven't been sitting still, strategy-wise. They've made some pretty interesting moves and brand messaging attempts recently, trying to stand out in what's, let's face it, a really crowded market.
Definitely.
Remember back in March 2025, the CEO, Barry Biffle, he made headlines. He called it a checkmate situation, talking about a new free strategy.
Right, the free bags thing.
Yeah, promising low fares, free bags, and more. Which, for an ultra-low-cost carrier known for fees, that sounds almost radical, doesn't it?
It does. It really does. Free isn't usually the first word you associate with them.
Not at all. So it ties into their ULCC model, but it's clearly an attempt to differentiate and maybe, just maybe, deal with some of those passenger gripes about being nickel and dimed.
It's a fascinating move. And honestly, it feels a bit daring for an airline that's historically been, pretty aggressive on those extra fees, the ancillary revenue.
Aggressive is one word for it, yeah.
Sometimes up to 40% or even more of a ULCC's revenue comes from baggage fees, seat choices, priority boarding, all that stuff.
Right.
So this free bag strategy, it's either a really calculated gamble to pull in a different type of customer.
Hmm.
Or maybe it's a forced move because of all the pressure, from consumers, maybe even regulators.
Good point.
It really makes you ask, how are they going to make up for that lost revenue? Will people actually value the free bag enough to book more flights with them? It's a big question mark.
It is the million-dollar or maybe billion-dollar question for them, isn't it? And they didn't stop there. In May 2025, they launched an unlimited companion travel benefit.
Ah, yes, for the frequent flyers.
Right, targeting loyalty. And that came after they unveiled something called Affordable Luxury and Unmatched Loyalty Benefits back in December 2024.
Affordable luxury. That's another interesting phrase for a ULCC.
It is. It shows this sort of dual approach they're trying. On one side, they're all about those rock-bottom prices, but on the other, they're throwing around words like luxury and talking up loyalty benefits.
Which traditionally don't really fit the no-frills image.
Exactly. It feels like a very delicate balancing act. Can they keep their costs super low while also trying to attract maybe a broader group of travelers, people who might usually avoid the budget airlines?
It suggests they're trying to thread a needle, appealing to the super price-sensitive folks, and maybe someone who wants a bit more perceived value, even if the base fare is low.
Yeah, value conscious, maybe.
Possibly. And this strategic push, it's not just marketing talk. They're expanding physically, too. Like, they're joining JFK Terminal 6 for operations starting in 2026.
That's a big move, JFK.
It is. It's not just about getting into the gate. It signals a long-term plan for growth, for having a presence in a really key high-demand city.
Makes sense.
And then, more directly on the operational cost side of things, remember in June 2025, they made that big engine decision.
Oh, right, the Pratt& Whitney engines.
Exactly, selecting RTX's Pratt & Whitney GTF engines for, 91 Airbus A321neo aircraft.
That's a lot of engines.
It is, and it's a huge commitment to modern fuel-efficient technology. It really underscores their long-term dedication to updating the fleet and, critically, keeping that operational efficiency high. That's still core to their model.
So investing heavily to stay true to the low-cost identity, even while they're experimenting with these passenger perks like free bags.
Seems like it. Trying to innovate on cost, while maybe trying to soothe some customer pain points at the same time.
Okay, so we've seen how Frontier tries to make its money, its strategy, but does it actually work? Does it pay off? Let's pivot now to the cold, hard numbers, the financial performance.
All right, let's get into it.
As of August 15th, the stock, ULCC, closed at $4.52. It had a small bump that day, up about 2%.
Sure.
Now, looking bigger picture, Frontier's market capitalization, the total value of all its shares is around $1.03 billion. Relatively modest, you could say.
For an airline.
But then their enterprise value is way higher, $5.34 billion.
Wow, yeah, that's a big gap.
It is. More than 5 times the market cap. Now, you mentioned this earlier, but what does that kind of gap usually signal?
Yeah, that's a really important point to flag. When you see enterprise value that much higher than market cap, it almost always points to a significant amount of debt on the balance sheet.
Okay.
Which, isn't uncommon for airlines. It's a capital-intensive business. Buying planes isn't cheap.
Right.
But for a company like Frontier, which we'll see has been struggling with profitability, that high debt level, that leverage, it can be a real burden. It can limit their options for future growth, especially if interest rates stay up, or it can really magnify losses if the economy takes a downturn.
A double-edged sword, then.
Very much so.
Yeah.
Debt helps you grow and buy assets, but it ramps up the financial risk significantly when times get tough, which, let's be honest, happens pretty often in the airline world.
Good context. Okay, looking at the shares themselves, they have about 228 million shares outstanding in total. But the shares actually available for public trading is much smaller, around 83.4 million. So a big chunk isn't readily traded, maybe held by insiders or restricted. What does that smaller float typically mean for the stock?
Well, a smaller float can impact liquidity. It might mean the stock is more susceptible to bigger price swings on lower trading volume, just because there are fewer shares changing hands easily. Something to keep in mind.
Got it. Now, the stock performance itself, it tells a really interesting, almost contradictory story, doesn't it?
It really does. It's a bit Jekyll and Hyde.
Yeah. So you look at the short term, and it's been strong recently, up over 35% in just a week, up almost 8% in a month, over 10% in a quarter. Looks pretty good, right?
Back to the surface, yeah. A nice bounce.
But then you zoom out. Over the last 6 months, it's down almost 47%.
Yeah.
Year to date, down over 36%. And the 3-year picture, down a staggering 68%.
Ouch.
Yeah.
Oh,
So that recent recovery looks more like a small uptick after a really prolonged, painful downturn. It suggests the company's faced some major, maybe even existential challenges that have just hammered shareholder value over the longer haul.
That long-term trend is definitely concerning.
And speaking of wild rides, the volatility is off the charts. Its beta is 2.62.
Wow, that's high.
Extremely high. For listeners, beta measures how much a stock moves relative to the overall market. A beta over 1 is more volatile. Over 2. That means Frontier stock tends to swing more than twice as much as the market average.
So big potential upsides, but also big potential downsides.
Exactly. If the S&P 500 moves 1%, Frontier might move over 2.5%. Not for the faint of heart. And the ATR, the average true range, confirms this shows significant daily price movement.
High risk, high potential reward territory.
Definitely. And looking at its 52-week range really paints the picture. The current price, around $4.50, is way down, like 56% down, from its high of over $10. But it's also way up, about 56% up from its low of under $3.
So it's been all over the map in the past year.
Completely a dramatic journey.
Okay, so that's the stock price action. Now let's dig into the engine room, so to speak. Profitability and efficiency metrics. And this is where, frankly, we see some pretty big challenges emerge.
Yeah, the numbers get tough here.
So bottom line first. Frontier reported a net income of negative $34 million
Right, a loss.
on sales of $3.78 billion. So bringing in revenue, but not keeping enough of it. When we look at the margins, it gets clear. Gross margin is positive but low at 3.34%.
Okay, so some profit after the direct costs of flying.
Some, but not much. But then the operating margin is negative 7.76%, and the overall profit margin is also negative at negative 0.90%.
So once you factor in all the operating costs, admin, marketing, everything, they're losing money.
Correct. These negative operating and profit margins are really critical. They signal that the core business, running the airline day-to-day, isn't generating enough revenue to cover all its expenses. It's leading to ongoing losses. That's a major, major hurdle.
Huge hurdle. And I assume that flows into the return ratios.
Absolutely. They're all flashing red, too. Return on assets, ROA, is negative 0.56%. Return on equity, ROE, is negative 6.63%. And return on invested capital, ROIC, is negative 0.78%.
All negative. What does that tell us in simple terms?
It basically signals profound inefficiency. They're not generating good returns. In fact, they're generating negative returns from their assets, from the money shareholders have invested, equity, and from the total capital they've put into the business. They're not effectively turning resources into profit. They're actually eroding value right now.
Wow. Okay, so given those really deep negative returns, it feels almost strange to hear about analysts projecting a big turnaround later. What could possibly be fueling that optimism? What are they banking on?
That is the key question, isn't it? And it highlights this tension in Frontier's story right now. If we look at revenue and earnings growth, we see a bit of a mixed picture, which might explain some of that forward-looking hope. On the plus side, they've shown decent longer-term sales growth. Sales grew over 22% over the past 3 years, about 8.5% over 5 years.
yeah.
And even the trailing 12-month sales growth year over year is positive 4.6%.
Okay, so the top line, the actual money coming in from ticket sales and fees, has been growing over time.
Yes. At a top-line level, they've expanded the business, brought in more revenue, which is generally what you want to see from a company aiming for growth.
Right, but more recently, that growth seems to have stalled. We saw sales quarter over quarter actually drop by 4.5%.
Correct. That indicates a recent slowdown, which is concerning. And when we get to earnings per share, EPS, the story gets really tough.
Uh-oh.
Current EPS for the trailing 12 months is negative 20 cents, and the projection for the next quarter is also negative at 34 cents.
So losses continuing in the near term.
Seems likely. And what's really striking is how sharply earnings have declined recently. EPS this year is down a whopping 428%. Quarter over quarter EPS is down 324%.
Good grief, those are massive drops.
They are. It reveals really significant recent underperformance on the profitability front. The losses haven't just continued, they've gotten substantially worse lately.
Okay, but then comes the twist, right? The forward-looking part.
Yeah, exactly. This is where that tension, that hope comes in. Despite the current deep losses, analysts are projecting a positive EPS of 10 cents for next year.
From negative 15 cents to positive 10 cents, that's a big swing.
It is. And even more eye-popping is the projected EPS growth for the next 5 years, 50.81% annually.
50% growth per year for 5 years? That sounds ambitious.
It's incredibly ambitious. It suggests analysts expect a massive turnaround in profitability. Maybe they believe those strategic moves, the fleet modernization, the new pricing, maybe even the free bags gamble will eventually pay off big time.
A classic pay now, gain later scenario.
That seems to be the bet. But it's a huge if, especially in the airline industry, and especially given Frontier's recent track record. And speaking of track record, we also see their recent EPS surprises were negative 9.85%, and sales surprises were negative 1.42%.
Meaning they've been missing analyst expectations lately.
Consistently on both earnings and revenue. That definitely adds a layer of skepticism to those very optimistic future projections. If they keep missing targets now, why should we fully trust the rosy long-term view?
Fair point. That makes those projections feel even more uncertain. Now, looking at valuation ratios, it gets complicated because of the negative earnings, right?
It does. You'll see the standard price earnings PE ratio
Mhm.
listed as just a dash because you can't really calculate a meaningful PE when earnings are negative.
Okay.
But the forward PE, which is based on those projected future positive earnings we just talked about, is very high, 45.07.
45. What does a forward PE that high imply?
It implies that investors, or at least the current stock price, are baking in an enormous amount of future growth and recovery. The market is essentially betting heavily that Frontier's profits will skyrocket next year to justify that kind of multiple. It's pricing in a lot of optimism, a lot of hope for that turnaround.
A high-stakes bet on the future, then.
Absolutely. Other valuation metrics. Price sales. PS is 0.27. Low, but makes sense given they're not profitable. For every dollar of sales, the market values the company just 27 cents. Price book PB is 2.04, so the stock's valued at about twice its accounting book value per share. Price cash, PC, is 1.83. And again, you see negative price-free cash flow and negative EV/EBITDA because of the current losses. EV sales is 1.41.
So a lot of these metrics are just reinforcing the current financial struggles, even though they generate a lot of sales.
Pretty much. They sell a lot of tickets and services, but they're just not efficiently converting that activity into bottom line profit right now.
Okay, we've hit the income statement, the balance sheet basics, but airlines especially need to manage their cash day to day and their overall debt load. What do the liquidity and debt numbers tell us about Frontier's financial health?
This is another area that raises some concerns. Looking at liquidity first, their ability to meet short-term bills. The ratios suggest potential challenges. The quick ratio is 0.36 and the current ratio is 0.41.
Both well below 1.0.
Yes. Generally, a current ratio below 1 suggests a company might struggle to cover its short-term liabilities. Bills due soon, with its short-term assets, cash and things easily converted to cash. These numbers are quite low, which could be a red flag for solvency if they hit a rough patch or need cash quickly.
Not a lot of wiggle room there. And how about the debt? You mentioned that earlier with the enterprise value.
Right. The low liquidity is unfortunately paired with pretty high debt levels. Their debt-equity ratio is a very high 9.62.
9.6. Wow.
Yeah. And their long-term debt equity is 7.60. These numbers signal a really significant reliance on debt financing compared to shareholder equity.
So they've borrowed a lot more than the company is worth in terms of equity.
Essentially, yes. And that makes them extremely vulnerable. Vulnerable to economic downturns, rising interest rates, unexpected operational problems. Just servicing that debt, paying the interest, eats up a lot of cash flow that could otherwise be used for investment or as a cushion.
That sounds risky for a company already losing money.
It is. Now, on the slightly brighter side, they do have some cash on hand, about $2.47 per share, and their book value is $2.22 per share, so there is some cushion. But the overall debt burden is substantial, especially for a company currently in the red.
Okay, a challenging financial picture, to say the least. Let's shift now from the numbers themselves to who owns them, who's buying, who's selling. And this is where Frontier gets really interesting, you mentioned.
Yeah, the ownership structure is quite remarkable. The headline number is insider ownership, a massive 63.43%.
63%. Owned by insiders, executives, directors.
That's what the data says. Exceptionally high concentration.
Okay, so my first thought is, wow, they must really believe in the company. They have a ton of skin in the game. Is that the right takeaway?
That's definitely one interpretation, and it's often seen as a positive sign, alignment of interest between management and shareholders. If the stock does well, they benefit hugely. However, it's absolutely crucial to look beyond just the ownership percentage and see what those insiders are actually doing with their shares. Are they buying more, holding, or selling? That's where the story gets more complex.
Ah, okay, so what are they doing?
Well, here's the twist. Despite that incredibly high ownership, the net insider transaction change recently is negative 0.88%.
Negative, meaning on balance, insiders have been selling shares, not buying.
Correct. It's a net selling figure. It might seem small, less than 1%, but given the huge ownership base, any net selling is noteworthy. And when you drill down into the specifics, it becomes even more revealing.
Okay, let's hear the specifics. This sounds juicy.
So when you see a CEO, for example, consistently selling large amounts of stock, even if it's after exercising options they were granted earlier, especially when the company is publicly talking about a turnaround, how much faith does that inspire? Is it just sensible personal finance for them, or does it signal something else?
That's exactly the question. What does the log show?
Well, let's look at CEO Barry Biffle. The records show multiple large sales, particularly in January and February of 2025.
Like how large?
For instance, on February 7th, 2025, a sale of 433,000 shares. That netted over $4 million. And often, these sales happen shortly after he exercised stock options.
Okay, exercising options then selling is common, but that's a big chunk of shares. Was he the only one?
Not at all. The president, James Dempsey, also had significant sales in February 2025. One transaction for over 318,000 shares, another for 300,000.
Wow.
And the executive vice president, Howard Diamond. Also big sales in Feb 2025, blocks of around 88,000 and over 326,000 shares.
Okay, so top leadership selling. Any directors?
Yeah. Director Josh T. Connor had multiple sales back in December 2024 as well.
So this isn't just one person diversifying. It looks like a broader pattern among key insiders.
It does appear to be a pattern of significant selling by top executives and at least one director during that late 2024, early 2025 period.
So back to my question. What does that suggest? Even with their huge stakes, they're cashing out significant amounts, personal financial planning, or maybe a lack of conviction that the stock's really going to take off soon, despite the public optimism.
It's impossible to know their personal motives for sure, right?
Yeah.
It could absolutely be diversification, estate planning, needing cash for taxes on the option exercises, buying a house, all legitimate reasons.
Here.
But for outside investors looking in, seeing consistent large-scale selling by the people who supposedly know the company best, it can definitely be interpreted as a red flag. It might suggest they don't see huge upside from current levels in the near term, or maybe they see more risks than they're letting on publicly.
It creates that actions speak louder than words kind of feeling.
Precisely. It creates a mixed message, especially when compared to announcements about free bags and future growth potential. It can definitely lead some investors to feel like management isn't fully betting on their own turnaround story with their own money.
Yeah, that disconnect is powerful. Okay, so that's the insiders. What about the big players? The institutions, funds, pension plans, etc.
Right, institutional ownership, they hold a substantial chunk too, about 40.39% of Frontier shares.
So combined with insiders, that's well over 100%. How does that work?
Good catch. There can be overlaps in reporting or slight timing differences in data sources. But the key takeaway is that both insiders and institutions hold very significant portions of the company. Let's focus on the institutional transactions, though.
Okay, what are the institutions doing? Buying or selling?
Interestingly, the institutional transactions show a positive change of 12.08%.
Positive. So institutions have been net buyers.
That's what the data indicates, net institutional buying. And this provides a really intriguing contrast to the insider selling we just discussed.
Totally different story. While insiders are selling, the big money managers are increasing their stakes. What could that mean?
It could mean a few things. Institutions often have longer time horizons. Maybe they see long-term value that insiders are less focused on in the short term. Maybe they're buying the dip, seeing the low price as a deep value opportunity. Perhaps they believe more strongly in that projected turnaround than the insiders currently do, or they have a different risk assessment.
So different perspectives, different time frames.
Exactly. It implies that different major players in the market are looking at Frontier through different lenses right now. And you see ULCC held in various ETFs. Some are airline-specific like GATs. Others are broad market or small-cap funds like IWM, VB, VXF, showing it's on the radar of different investment strategies.
Fascinating divergence. Okay, one more group to consider. The short sellers, people betting against the stock. What's the short interest picture?
This adds another layer of negativity, frankly. The short float is 18.57%.
18.5%. That sounds really high.
It is substantial. It means that nearly 1/5 of the shares that are available for public trading are currently being shorted, borrowed, and sold with the hope of buying them back cheaper later.
Wow. So almost 20% of the tradable stock is involved in a bet that the price will fall.
Correct. The short ratio is 3.94, meaning it would take about 4 days of average trading volume for all those shorts to cover their positions. And the total short interest is about 15.5 million shares.
So what does that high level of short interest tell us? What might those short sellers be seeing?
Well, typically a short float, this high, signals deep-seated pessimism among a significant group of investors. They might be focused on the company's unprofitability, the high debt levels we talked about, the fierce competition in the ULCC space, concerns about the free bag strategy backfiring, or maybe broader macroeconomic headwinds they think will hit Frontier particularly hard.
So they're betting on those challenges outweighing any potential turnaround.
That's the logical conclusion. It's a strong bearish signal, a direct counter-narrative to any bullish case, suggesting many believe the current price is still too high or unsustainable.
Okay, so we have insider selling, institutions buying, and a big chunk of the market betting against it. That leads us perfectly into the broader narrative. What's the news flow and the analyst sentiment been like?
Yeah, let's connect the dots with recent events. Starting with earnings calls, always a key moment. The Q2 2025 results reported in early August were not great. They reported another loss and missed revenue estimates. That was noted by sources like Guru Focus and Zacks.
And that continued a trend, right?
It did. Q1 2025 earnings back in May also showed a loss and missed revenue targets, even though the company tried to put a positive spin on revenue growth despite challenges.
So 2 consecutive quarters of losses and misses recently?
Yes, and it's important context that this recent slump came after a stronger period. Their Q4 2024 results, reported back in February 2025, were actually described as solid with record revenue.
Ah, okay. So things seem to be going better at the end of last year, but then took a downturn in the first half of this year.
Exactly. That recent deterioration from late 2024 into mid-2025 is quite stark. It raises questions about what changed. Was it unexpected costs? Did market conditions worsen rapidly? Or maybe, as we speculated, is that free bag strategy hurting ancillary revenue more than expected without enough of a boost in passenger numbers yet?
Lots of possibilities. And what about the wider industry context? Are other airlines facing the same headwinds?
It seems to be a mixed bag across the sector. We saw headlines in August, for instance, like United and Delta are S&P 500's top stocks today, thanks the inflation report.
So good news for some airlines based on macro data.
Right. It shows that macroeconomic factors, like inflation news, can impact different airlines very differently. Not everyone is weathering the storm the same way. Some legacy carriers might be benefiting while ULCCs struggle.
And are there headlines specifically challenging the ULCC model itself?
Yes, and this is potentially very significant for Frontier. Articles like, "You may soon have one fewer option for a low-cost flight," from August 2025. Or even more directly, "It's the end of cheap flying as Americans tire of budget airlines," from Bloomberg back in May.
End of cheap flying.
Yeah.
Wow.
Headlines like that directly question the core premise of carriers like Frontier. If travelers really are getting fed up with the stripped-down service, the extra fees, the whole budget experience, that strikes right at the heart of Frontier's business model. It could force a major rethink if that sentiment becomes widespread.
That feels like a potentially massive shift, if true. And we've seen broader concerns too, right, about airline stocks in general.
Absolutely. Headlines from April like, "Airline stocks have plunged in 2025, value trap," or "deep value," show the whole sector was under pressure. And specifically for Frontier, Frontier stock falls on reduced consumer confidence impact, also in April.
So economic worries hitting them directly.
Seems so. And analysts were picking up on this too. UBS analysts downgrade airlines amid recession fears in April, highlights how fears of a broader economic slowdown can quickly sour sentiment for the entire industry, which is very sensitive to economic cycles.
Makes sense. People travel less when money's tight.
Exactly. And one specific point that keeps coming up, especially for ULCCs, is that junk fee debate.
Ah, yes, the ancillary charges.
Right. Remember that Senate hearing back in December 2024 where airline execs got grilled? A senator flat out said, "Travelers are quite simply fed up."
Strong words.
And absolutely critical for Frontier, Spirit, Allegiant companies whose model relies heavily on those extra fees for bags, seats, everything. If regulations clamp down hard, or even if consumer backlash forces changes, it could directly hit their revenue streams.
And Frontier hasn't exactly helped their image on that front, have they? Wasn't there that quote?
Oh yeah, the infamous one from December 2024. "Frontier Airlines says you're a shoplifter if you don't pay for your bag."
Ouch. That's not subtle.
Not subtle at all. And a perfect example of the aggressive stance they've taken on fees and the kind of friction it creates with customers. That kind of PR combined with potential regulation, could really damage the brand and push travelers towards airlines with simpler, more upfront pricing. It turns a revenue source into a potential liability.
Yeah, that shoplifter comment really stuck out. Okay, shifting slightly, what about industry consolidation? Weren't they involved in trying to merge with Spirit?
They were. That was another significant event. Back in January 2025, news emerged about Frontier making what they called a compelling proposal to combine with Spirit Airlines.
Another ULCC. What was the idea there?
The logic was pretty clear. Merging the two would create a much larger, more dominant, ultra-low-cost player. They could potentially achieve huge cost savings economies of scale in buying planes, maintenance, coordinating routes, and also reduce competition between them in key markets.
Sounds powerful on paper. What happened?
Spirit rejected Frontier's proposal. Instead, Spirit ended up pursuing its own path out of bankruptcy, apparently aiming for a go-private deal around February 2025.
So the merger failed. What does that tell us?
It highlights just how competitive and challenging the environment is, even for consolidation attempts that seem logical. And for Frontier specifically, it means they missed out on a potentially game-changing opportunity to rapidly gain scale and market share. They're left having to rely on organic growth, which is much harder in this tough market.
Right, a missed opportunity. Okay, let's bring it back to Wall Street analysts. What's the overall consensus view on Frontier right now?
Well, looking at the composite recommendation score, it's 3.09.
And on that standard 1 to 5 scale, where 1 is strong buy and 5 is strong sell.
A 3.09 generally leans towards hold, maybe slightly towards sell. It definitely doesn't signal strong bullish sentiment from the analyst community overall.
Okay, cautious at best. And what about their price target?
The consensus target price is $4.69.
Which is basically right where the stock is trading now, maybe slightly above.
Exactly. It suggests analysts, on average, see very limited upside potential from the current price in the near term. Not much room to run, according to them.
And has this sentiment been consistent, or has it changed recently?
This is a really crucial trend. There has been a consistent string of analyst downgrades for Frontier stretching from 2023 right through mid-2025.
A string of downgrades, not just 1 or 2?
No, it's been pretty widespread. For example, Deutsche Bank cut them from buy to hold in March 2025, slashing their price target significantly. JP Morgan downgraded them from neutral to underweight back in July 2024.
Okay.
And we've seen similar negative ratings, actions, or target cuts from other major firms, Citigroup, BofA Securities, Morgan Stanley, Evercore ISI, TD Cowen, all across this period.
Wow, that's a strong pattern of negative reevaluation from reputable firms.
It really is. It's a significant indicator that confidence in the company's prospects has been steadily eroding among the professional analyst community. They seem to believe the operational headwinds and market challenges are more serious or persistent than maybe previously thought.
That pattern of downgrades is pretty damning. It makes those super optimistic long-term EPS projections we talked about seem even more questionable, doesn't it?
It certainly adds weight to the skeptical view, yes. Yet, despite this wave of downgrades, you do still see some conflicting headlines popping up.
Like what?
Well, things like poised for a turnaround after losing from March 2025, or even questions like, is Frontier Group Holdings, Inc., ULCC, the best airline stock to buy now? From April.
So even with the downgrades, some people are still seeing potential.
Apparently so. It shows that there's still a pocket of the market, maybe some investors or specific analysts, who believe in a recovery story or see deep value at the current depressed price. Perhaps they're betting heavily on those cost cuts fully working, or the free bag strategy eventually winning over customers.
It just creates this fascinating clash of opinions, doesn't it? Bull versus bear playing out very clearly.
It really does. It highlights the complexity and, frankly, the speculative nature of investing in a company like Frontier right now, given all these conflicting signals.
Definitely. One last quick mention on the operational side. Didn't they have a major IT issue recently?
Yes, good point. Briefly, back in January 2025, they had an IT outage that led to a nationwide ground stop for their flights.
That sounds disruptive.
Very. While it's not a direct financial line item like debt or revenue, these kinds of operational meltdowns can have significant ripple effects. They hurt customer satisfaction, they cost money in cancellations and rebooking, and they damage the brand's reputation for reliability. In an industry where being on time is paramount, these outages just add another layer of difficulty.
Another challenge on the pile. Okay, beyond the main financial and news stuff, just a couple of other quick notable mentions that came up in our research.
Sure.
Frontier actually holds a couple of U.S. patents, something called a magnetic operator interface assembly, granted in 2023 and 2021.
Interesting. Any idea what that relates to?
Not specifically from the titles, but it suggests maybe some internal innovation happening, perhaps related to their operations, maybe in the cockpit or cabin, could tie back to that relentless drive for efficiency or optimizing the passenger or crew experience somehow.
Possibly. Always looking for an edge.
And conversely, it's also worth noting what we didn't find data on in the sources.
Right. Important to mention the gaps.
We found nothing specific on Congress trading activity related to ULCC, no data on corporate lobbying efforts, and nothing about government contracts.
Which means we can't really analyze any potential influence from or benefits derived from political connections or federal spending, which can sometimes be a factor for big companies, especially in regulated industries like airlines.
Exactly. So our analysis today is purely based on the financial, market, and news data we had available.
Understood.
Okay, so wrapping this all up, we've covered a lot of ground. What does this whole complex picture mean for you, the listener, trying to make sense of Frontier? We've seen this really fascinating, sometimes downright contradictory set of signals, haven't we?
We really have.
You've got that incredibly high insider ownership, which usually screams commitment, but then you have active selling by those same insiders raising questions.
All right. A paradox right there.
Then the company talks about low fares done right, but is also trying to sprinkle in affordable luxury, this almost impossible sounding combination.
While simultaneously facing this industry narrative, saying maybe the era of cheap flying is ending, and dealing with real customer anger over junk fees.
Exactly. And the financials reflect this tension. Positive sales growth over the longer term, which is good, but deep, deep red ink on the bottom line right now, negative income, negative margins.
All despite those analyst projections for a dramatic turnaround in the future, projections that are being met with increasing skepticism, evidenced by that string of downgrades.
It really paints a picture of the dynamic, often paradoxical world of finance and how a company navigates it, especially in a sector as tough and consumer-facing as airlines.
It does. Frontier seems to be walking this incredibly fine line, trying to balance extreme cost-cutting with keeping customers happy enough to fly them, all while the market around them might be fundamentally changing.
And for a business like Frontier, every single move, a new pricing strategy, an earnings report, a negative headline, it all feels magnified because the stakes are so high and the model is so specific. It's not just about the numbers, it's the whole story, the narrative, and how they adapt.
Absolutely.